Good day, fellow investors. Steven gives a great comment. If you're under 50 to 55, which he assumes 90% of our viewers are, nothing could be better for your investing journey than a deep bear market for stocks that lasts for years. Make money in your career, buy the S&P at a discount for an extended period of time, and you will be rewarded insanely well. Well, let's start with age and gender for the assumption he made, and unfortunately I'm not good with the ladies. Aline is watching and commenting, but that's about it. So, I don't know, I'll try to do something special there. But if we look at age, yes, 90% of you watching is under the age of 55, which means that a market crash, as Steven is saying, would be the best thing for you and not the S&P 500 at 5,000 points like most investment banks are projecting. And I really wanted to touch on this comment because it is the essence of investing, and it's always good to remind oneself that a crash for 90% of the population, but I think even for those 60, 70, if you have a well-structured portfolio, is always better because it's simple mathematics, and we are all excited when stocks go up, yeah, but it's detrimental to your long-term wealth. That's how it is. Because yes, stocks go just up, and everybody is happy. However, if you look at things, you see that there are these long periods when stocks do practically nothing, and that's actually the periods where you accumulate, and then here or there, when the boom is there, when the boom comes, that usually comes, you invest. And perhaps this is an even better graph to look at. You see here the historical 20-year compounded annual growth rates for the S&P 500. And you can see that when the stock market is high, like in 1999, when you go 20 years forward, the actual return rate is 3% per year, which is not much. When stocks are extremely cheap, like in 1981, the 20-year return rate was 17% for those investing at the 1980 lows. And then if you think about it, it's better that stocks are cheap rather than expensive, because the money you're putting now into the market will give you a very low return because stocks are expensive. The money you're putting in the market at the crash will give you a very high return. Let's look at the cyclically adjusted price-earnings ratio that takes into account 10 years of S&P 500 earnings. Now it is at a level of 30. Similar to the late 1990s, it was also that high the roaring 20s, high in the nifty 50s, 60s, but if you look at the stock market, the returns from 1929, from 1969, from 1999, for the next 10-20 years were terrible. However, those that bought March 2009, 1981, the whole late 1970s, those people did great. 1950s, 1930s, those were the times to really pound on stocks. Because if you just look at the dividend, for example, the dividend now is 1.5% on the S&P 500 level. However, the current dividend on the 2009 level was 9%, is 9%. I think also the bottom here was 666, so 10%. Now, what's better to invest? At 9% dividend yield or 1.5% dividend yield? And this is the essence of investing. But investing in these crashes is hard. And people find it easy to invest. Now, stocks are going up. We have seen the S&P 500 predictions. The market will be at 5,000 points next year, easy 10%. But history tells us that long-term returns will be between 0 and 5% long-term. and people are rushing into the market now. And that is bad, because if you look at the average investor return over 20 years, the first 20 years of this century, it was 2.9%. However, the market did 7.5%. And this is the key. Investing, being excited that stocks go up, is not good. Buying at peaks is not good. It's better to buy all the time, or even better to buy when stocks are cheap, and then on most of your money you're making better and better returns. As said, now you think, okay, but where we are going to find the crash? How to buy in a crash? Well, it's not that easy. People like buying stocks that go up. Here's a crash. This is China Internet ETF. It has never been this cheap. This is a crash. This is something that looks ugly, but would you buy it? Of course not, because, oh, it's China, it's risky, it's ugly. That's exactly why it is cheap. And when the S&P 500 was cheap in 2009, nobody was touching it because it was the end of the world as we knew it. But that's exactly when one needs to buy more. And if you just can add this not intuitive strategy to your toolkit for investing, I'm sure that over a lifetime, this video could add millions to your wealth. Because it's just these little things, not doing stupid things, as Charlie Munger would say. Buying more when it's cheap, buying less when it's expensive, makes all the difference. Thanks for watching. Check my research platform to see what I am buying on the cheap, of course, and then we'll wait patiently until the value is realized. I'll see you in the next video.